and welcome to this programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts. Today we are talking to Chris Davies, co-manager of the Baillie Gifford European Growth Trust. So welcome, Chris, thank you for joining me today.
Thanks, Amy, thanks for having me.
So the title of this webinar is Unsung Heroes and Turning Points on the Forgotten Continent. So I'm excited to hear more about those opportunities. So let's begin. The European Growth Trust is filled with what you and the team believe to be some of the most dynamic growth companies in Europe. Now, do you think the holdings all share common characteristics in that regard?
Very much so. In fact, we look for a set of common characteristics across all of the companies that we analyze, and the ones that we've invested in are the ones where we recognize these characteristics. So one of those would be secular growth drivers. So demand for products or services that these companies are providing that's growing. So this is not a GDP type portfolio. So if you look at the revenue growth of this portfolio over the past 5 years, it's above 10%. The index is at around 4%. And we've got a diverse collection of secular growth drivers in there, from the proliferation of semiconductors to the pricing power of luxury brands to companies that grow through acquisition, but there are plenty of others. So that's a core tenet. A second would be the presence of competitive advantage. So what do we mean by that? What we mean is that we're looking for companies that don't just grow over the long term, companies that actually thrive over the long term, because they can do something that others simply can't or find it very difficult to copy. So that in turn allows companies to grow their profits disproportionately, make excess returns on capital. So what we're thinking about with competitive advantage really is the durability. It's what you get when you invest over a long period of time. A business that has a competitive advantage is going to give you really superior returns. So if you look at ASML, for example, which is a Dutch lithography business which we invest in, it's right at the cutting edge of lithography of the whole semiconductor industry. And it's extreme ultraviolet lithography machines.
Just to clarify for our audience, to define lithography, if anyone's unclear of what that process is.
So it's basically where you use light to make patterns on silicon wafers. And then those can be made into chips, which go into everything from smartphones to laptops to microphones and goodness knows what else. But they have this really exceptional competitive advantage in this field as basically the main innovator in the world. So at the really extreme end, and when you think of some of the new applications in AI and LLMs and so on, where you really do need lots of computing power, these guys are very, very important for helping to continue to drive Moore's law. And when you look at the extreme ultraviolet lithography machines, which are really at the cutting edge, they basically have a 10 to 15 year lead on the competition. So that's a pretty strong competitive advantage. When you look at the financial characteristics, they've grown about 18% over the last decade, and their margins have expanded from the mid-20s into the mid-30s, and they make fantastic returns on capital. But of course, it has a right to do so because it has this competitive advantage. So that's really the second thing that we see across all of the companies in our portfolio. The third thing that maybe is a bit more unique to us is what we call alignment. And what I mean by alignment is that we are aligned as long-term investors with other stakeholders in the business. We're long-term, as you know, so we like to be invested alongside families or founders or trusts or foundations who we know will be there in 10, 15, 20, maybe even 50 years' time. We tend to think that tilts the odds in our favor. So one example would be Atlas Copco, which is a Swedish compressor business. We have held the shares at Baillie Gifford since the mid-1980s. But they are backed by the Wallenberg family, which is one of Sweden's famous, rich, long-standing families, and they've backed Atlas since the 19th century. One of the other characteristics I think we look for here is attractive financial characteristics. So again, when we look at the portfolio, we see businesses that generate these attractive returns on capital. That's really important for compounding, which Einstein famously described as the eighth wonder of the world. And when we look at our portfolio, the returns on invested capital, which is a really important metric that we use for judging how valuable growth is in these businesses, it's about 14%, which is pretty much double where the index is. Before I finish this very long-winded answer to what was quite a simple question, Amy, I'll also point out that the common factor we think across all these companies we think they're underpriced. We think that the market is getting something wrong about these businesses. Now, we have a rough rule of thumb in the European Growth Trust where we are looking to double our money over a 5-year period. So that's what we think are the common characteristics across the portfolio companies that we hold today.
Okay. And many people would say we're coming, well, factually we are coming out of the era of easy money, for which many businesses, many growth businesses had relied on to obviously grow market share and to kind of get that competitive advantage which you talked about. So how do you separate the companies that have kind of ridden that funding wave and those that with those really solid fundamentals that you're going to be there backing in the next decade?
Well, it really is these points that I've just talked about, really. I guess it's getting beyond the growth rates to figure out how durable that growth is. And that depends on the competitive position, who's running the show, how they're incentivized, the financial characteristics. Plenty of companies can grow, and I think we learned that during that period where interest rates were very low and companies were able to secure capital quite easily. But it's that growing sustainably and with attractive returns on capital over the long term that I think is what we are really trying to find. And those fundamental strengths of companies are what you need to focus on. But our experience teaches us that even in cases where you have a strong company, you might find yourself having to adopt the brace position every once in a while because long-term gains often requires an investor ride out short-term share price volatility. So Atlas Copco, for example, has compounded its earnings per share at 10% over the last 20 years, which is a pretty astonishing record. But there have been at least 5 years during that period where earnings have fallen and several periods where the share price fell quite significantly. But that's been the biggest returning stock in our European fund, which is the sister fund to the Baillie Gifford European Growth Trust. So that's a great example of a company that has just lasted the distance. More recent examples, perhaps, to illustrate what we've learnt, certainly during the last 5 years, would be perhaps the food delivery companies that we invested in, like Delivery Hero and Just Eat Takeaway, both of which we have sold. Neither of those businesses was able to make a profit during the course of the pandemic, which is unusual given that the demand for their services was...
Nobody could leave the house.
Well, exactly. That they couldn't generate profits and generate attractive returns on capital in the best possible environment, I think was quite indicative, and we probably should have sold them sooner for that reason. Contrast those with Allegro, which is Poland's leading e-commerce website. That business has a dominant position. It's fought off numerous competitors, including Amazon. It's added a number of different products and services to its business, like payments and advertising. It's investing heavily in 5 additional countries outside Poland. So that business has kept investing quite heavily and is actually making decent returns in doing so. And we think that it's got the staying power to keep doing that over the next 5 to 10 years and possibly even beyond. So we're really trying to disaggregate, which are the businesses here that are going to be able to keep investing at attractive rates of return over the long run versus those that we think really can't. Okay.
Now, we hear a lot about Western economies' kind of debt overhang. The title here is the Forgotten Continent. With so much debt in the system, not just in Europe, we're seeing it in the US as well. Can that be a barrier to growth? And how does a company's sort of pricing power come into that equation there?
Mm-hmm. Mm-hmm. So we describe ourselves as bottom-up investors. What does that mean? It means that we start with the attractions of the company first. So we don't really spend very much time at all talking about the broader macroeconomic picture. And the beauty of focusing on companies that are driving or benefiting from secular growth is that their growth rates can often be zigging while the broader economy might actually be zagging. So maybe that just sets the scene briefly. But when we look at the portfolio, pretty much every company here has a number one or number two position in what it does. Now, to answer the question on pricing power specifically, pricing power, as most people probably know, is when you put your prices up and you get limited pushback from your customers, you have pricing power. Now, companies with pricing power might be doing something extremely valuable for customers that others simply can't do. It might be that customers find it very expensive or disruptive to switch from one provider to another. Those are usually pretty good preconditions for pricing power. And we think that we can see those sorts of conditions across most of our portfolio. So maybe to bring that to life with a few examples. Spotify, which probably doesn't need much introduction at all. Mm-hmm. Music is under-monetized. So when you look at some analysis which UBS did quite recently on the global recorded music industry, what they pointed out was that revenues per capita are actually half what they were in 1999, adjusted for inflation. Now, I'm not sure how many people watching this webinar have got Spotify accounts, but I think it's fairly clear that it provides an enormous amount of value for the amount of money people are paying for it. If you think back to, when I was a kid and I was buying music, I'd have to buy the albums, I'd have to buy the singles, but I didn't have an infinite amount of money, so I could only buy a handful, and then I'd have to put the radio on and hope that my favorite song was going to pop up at some point. Spotify solved that problem, and it's added audiobooks and podcasts on top of that as well. Now, they've actually been putting up prices recently in some key markets, including the US, and we've seen very limited impact on churn. Now, why is that? The reason is it's partly this point that they're adding incredible amounts of value for customers and they're really undercharging. But it's also, if you think about the inertia that customers have, all of your playlists, all of your favorite albums are all organized there. It's like your own personal musical organizer. Yeah. It's going to be very, very difficult to switch. The switching costs are actually quite high. So that's one reason it has pricing power.
But that's interesting in terms of how it's working for music. But if you look, say, for like TV streaming, it's quite a saturated market in that respect, isn't it? So Spotify really, it's interesting that in music it's really cornered the market, but in sort of TV and sort of films, it's quite hard to justify raising your subscription, I suppose.
And the other oddity here as well, Amy, is actually that if you look at Spotify, it has pretty much most of the same music that Amazon Music has. It has most of the same music that Apple Music has, which makes it more of a head scratcher when they are able to put up prices and they don't see much churn. And our reasoning for that is, I think it's this point about, when I look at my phone, all the music I like to listen to is there. It's organized for me. But what Spotify also does is it knows you, it gets you, and it gets a sense of what you like to listen to. So it can recommend things to you much better. There were some interesting numbers which came out of Universal Music Group recently where they talked about their streaming business as actually not being that strong. Now, I'm not sure whether what they were really saying was that they've not seen much strength from Apple and Amazon and some of the other players, but Spotify's numbers have been consistently really very impressive recently. That's interesting to us. I think that's telling us something about what they're doing that's adding a lot of value, that's giving them pricing power. And I think it's those points that I've talked about there.
Okay, excellent. Did you want to add something more on pricing?
Well, there's a few other examples I could give on pricing power as well. So let's take Shipstead. So this is a Norwegian media business which dates back to the 19th century. It's recently split up. So it was originally a news business, newspapers. More recently, it has become a pure play online classifieds business. So they made a big move back in the late 90s, early 2000s into the classifieds market. So essentially taking classified ads from papers and magazines and putting them online. So very much the same sort of thing as Rightmove and Auto Trader in the UK, for example. They own the dominant online classifieds business in Norway, which is called Finn. It has 90% plus market shares in real estate, in cars, in jobs, pretty much all the main categories that we can think of. And what's interesting there is that they've been putting up prices, particularly in their real estate business recently, having not really priced very much for quite a long period of time. And they can do that because they have the dominant market position. That's where all the eyeballs are. All of their users are using that app. So even if a competitor comes in and tries to get the estate agents on board, putting their inventory there, it's going to be very difficult for them because they'd have to attract all of the eyeballs of your typical Norwegian who actually spends most of their time looking at Finn. And there's a great benefit of having all of these different categories in the same place. But you've got to be careful with pricing power here. You can't just pull the lever and expect everything to be fine. You also have to add value to the customer. I mean, back to the Spotify example, they're adding a lot of value for their users. So with Shipstead's case, with Finn, when you're putting up prices, you always have to think about how you're adding value for customers. On the other hand, we've got some luxury businesses in the portfolio. So let's take Ferrari, which we don't hold directly. We hold it via the holding company Exor. So it accounts for quite a big proportion of Exor's asset value. Ferrari makes about 14 different models of car. The range models tend to be between, say, 200,000 to 600,000 euros. But their special series and Icona models tend to be, €1 million plus, maybe even up to 1.5 million. When you look at the cars they sold last year, about 3/4 of them were bought by people who already own a Ferrari. So it's a sort of club. It's like a cult almost. So that gives you tremendous pricing power as well. So a few different examples of pricing power, but I think the broader point here is that pricing power just gives you that opportunity to control your growth rate, perhaps in a way that the macroeconomy might not allow.
And I suppose it goes back to the earlier point about the end of the easy money era. You really have to, to sort the wheat from the chaff, you have to be providing a service that people want. Because
exactly.
Otherwise you can't fund yourself. So it has to be the best of, otherwise you can't operate.
Exactly. And we've seen that with so many companies who've essentially been reliant on very cheap capital that have really struggled to continue investing in their business when the cost of capital has gone up. The beauty of being able to exert pricing power is that, as you say, you are able to generate more capital internally and use that to fund research, development, CapEx. You can keep improving what you're doing for customers and add more value over time. And that's a beautiful flywheel effect.
I was keen when I was looking at inside what you're holding in the trust. There's quite a lot of holdings residing in the Netherlands. So I was just keen to understand why. I mean, we've talked about ASML, which is a huge success story, of course. But there was a couple more in there. Topicus, an acquirer of software companies, is the trust top holding, and Adyen is I'm not sure if the pronunciation is right there. Sorry, is a Dutch digital payment processing business, which is growing at sort of 25%, which is pretty impressive. So, is there something unique in Dutch culture which is bringing out such great entrepreneurial businesses?
It's a great question, and I must admit that I don't have a great answer for it, but what we've learned from Sweden might have some relevance here, because they are both big overweights for the trust. We have very big positions in Sweden and the Netherlands, but it's not because we've taken a top-down view on these countries. We think these are amazing countries. We've just happened to have found a lot of great businesses there, which may actually be telling us that there is something about these countries that's quite special. There's a good book called Capital Returns, which I think was published by Marathon Asset Management. And there's a great chapter in there called Northern Stars, where they talk about the Nordics. And actually, it turns out that Sweden is one of the best performing stock markets of the 20th century. And that's something that chimes with us, because when we look at some of our great successes in the European fund, which is, as I mentioned earlier, the sister fund to the trust, which has been running since the 1980s, a lot of them come from Sweden. I mentioned Atlas Copco earlier. It is the highest returning stock in the European fund. So what is it about Sweden that has produced these special companies, and what might that tell us about the Netherlands? Well, there's a few things, I think. One is that there's a lot of long-term capital in Sweden. I mentioned the Wallenberg family, but there are lots of other families there, lots of family holding companies with a very long-term perspective that are willing to invest in companies and let them invest for the future. The level of English literacy is very good across both these markets. So that's quite good for recruitment, for sharing ideas, for cultural exchange. They're quite small markets. I mean, Sweden is, 10 million people? The Netherlands, maybe 17 million. And what that means, I think, is that, you exhaust your home market much faster. So you've got, if you want to keep growing, you've got to go abroad much, much sooner in your life cycle than perhaps a company that's operating in France or Germany, perhaps. And we've definitely seen that with Atlas Copco, which has got a tremendous global compressor business now, which in a way that it certainly wouldn't have had 50 years ago. So I think when you look at these factors in Sweden, you can kind of see some of them in the Netherlands as well. So the two examples you mentioned, Topicus and Adyen, let's look at the long-term ownership of both of those companies. For example, Topicus was spun out of Constellation Software, which is a Canadian software company. But Constellation bought a business called Total Specific Solutions back in 2014, which was a Dutch company. It was buying these vertical market software companies, which are sort of niche software companies. Think of software that you're using to run a hairdressing salon or a gym or a golf club, that sort of thing. And they started acquiring more of these companies in Europe and was then bought by Constellation. But the family behind TSS is still very much there. The Strickwerder family, represented by the CEO of Topicus, Robin van Pruya. I'm sorry, Robin, I've probably butchered your name. I have no idea how to pronounce it. But there's a long-term ownership story there. And it's interesting when you read what the Strickwerder family say in the press, how they talk very much about being long-term. And Adyen is another good example where you've had two founders heavily involved really since the company was founded back in 2006, but they've been involved in the payments business for much, much longer than that. And they've stuck around, they've been long-term investors. And so I think when you start looking at the Netherlands and comparing it to Sweden, I think you can probably find that there's quite a few commonalities across those two markets, which might go some way to explaining why we have these big overweights in those countries. As
you say, that long-term capital, and you mentioned earlier, at some points you're going to have to adopt the kind of brace position in holding these positions, but they have, they've weathered those storms and they've been patient, which you can see in the results, which is fantastic. That moves us nicely on to the next question, because I wanted to talk about the unlisted companies in the portfolio. It makes up around 10% of the portfolio at the moment, but you do have the option to increase that to 20% of the total trust. And it's really quite an interesting time for private assets. We're hearing more about it in the kind of mainstream media, as it were. And in the investment trust space, there is a perception of kind of mispricing here, which is leading to the discount widening. What's your sort of perception on this dynamic?
Yeah, I think there's a few possible reasons. I mean, the discount at the moment is probably somewhere in the region of 14% to net asset value, which is quite wide, certainly in the context of our peers. I think there are a couple of possible reasons for that. One is probably performance. We have had a tough period of underperformance recently, and that was coming out of a period of extreme outperformance in 2020 and certainly the first half of 2021. I think that's probably a factor. I think the other is, as you say, when people look at unlisted companies, and we have 5 in our portfolio, and we've tried to be very selective about the ones that we've gone for. There is some subjectivity around the valuation of these assets. Now, we tend to be very conservative. We have very robust systems for valuing these companies. But because they don't have a market price in the way that our public investments do, there's always a room for debate around those. Now, the bigger question here, I think, is why bother? Why look at unlisted companies? Why put them in the portfolio? I think there's a few reasons. One is that we know that private companies generally have been, staying unlisted for perhaps a bit longer, and we want to be able to get access to these really special companies in Europe as early as we can. So in being able to invest in these companies while they're private, I think is a really important advantage. It's a way of accessing those returns that special companies can make as early as possible. So that's one important reason that we do this. But as I say, we've tried to be very selective. We have 5 companies in the portfolio that are unlisted. Some of those will IPO over the next few years, we would imagine. We'd have to wait and see, of course. But fundamentally, we believe that these companies are going to deliver superb returns over the long run. And that's why we do it. And I mean, your point about the discount, I guess, Stephen and I would very much, so Stephen, my co-manager, and I would very much agree, because we own quite a lot of shares in the trust ourselves. We've probably been net buyers over the course of the last year, while that discount has been quite wide. So take of that whatever you want. But I think we would generally agree that the trust looks quite cheap at the moment.
I suppose if you're buying a high quality selection of underlying companies at a discount with a wrapper that's got a discount, it's quite an interesting time to be a buyer, I imagine.
We probably agree with that.
Okay, so we've got some of the remaining questions I have. We've kind of broadly touched on. I just wanted to get into the why are many of these successful companies of the future staying private for longer? What's at play there? And perhaps you could, the benefits of remaining private and the unlisted company exposure of the trust. So I suppose a little bit about illiquidity. And finally, maybe just to colour it, maybe an example of one of the private companies within the portfolio.
Sure. Well, I'll take each of those in turn. So one of the reasons I think companies are remaining private for longer is that there are a lot of companies out there these days that don't need much capital. So actually you can get to a point where you're pretty self-sufficient quite quickly. So there's less of an onus on you to come to the market to raise capital. Another reason I think is that the market can be quite a hostile place at times. What we would observe in Europe is that there is probably much more hostility towards investing for the long term than there is in the US. I think there's probably less tolerance in Europe of companies remaining unprofitable for a period while they invest to build their business, build their user bases, build their competitive advantage. But in a lot of cases, that's been absolutely the right thing to do. I mean, we mentioned Spotify earlier. I mean, they've been investing a great deal to build their user base. They still are investing a lot. And to build the offering, to improve the product, to improve the service, such that at some point in the future, they can put up prices and make profits. And that they have recently swung to a profit after a long period of not really making much money. But we think that the future now looks an awful lot better. But it was absolutely the right thing for them to be able to invest. But it was hard for them to do that, in Europe. Now, it helps that Spotify probably has quite a strong American identity as well. But where there's a lot of hostility to long-term investment, that can often make it difficult for companies to realize their ambitions. And we are very cautious about that. We want to find those companies that are willing to take that leap. And that's one of the reasons that you might just decide to remain private. And there are, believe me, there are plenty of companies that we talk to who wish they were still private companies for that reason. I mean, you asked about the benefits of illiquidity, and I guess that's also kind of asking about patience, because if you're taking a risk on illiquid assets, private assets, then you are essentially locking in an investment time frame, because you don't really trade these assets in the way that you're able to trade on the public market. One of the benefits of patience, I think, generally is that it's to do with the way that equity market returns work. I mean, we know that there is an asymmetry, a profound asymmetry in equity markets, whereby the top returning stocks will return enormous sums of money, many, many multiples of your original investment, whereas the downside is capped at 100%. So that's kind of what we mean when we talk about the asymmetry of returns in equity markets. Now, one of the obvious benefits of patience is that you get to take advantage of that. I mentioned Atlas Copco earlier on. That's been one of the best returning stocks for our European fund, but you needed to be patient. You needed to hold it. People tend to talk a lot about buying and selling, but what about holding? What about the discipline of continuing to hold great companies over the long term? So that's one of the really important things here, that you need to have the patience. And investing in private companies in a long-term vehicle like the trust, I think, is a really good expression of that patience. And maybe to try to bring some of the unlisted companies to life, as I mentioned, we have 5 private companies in the trust. We tend to be selective. We've looked at a great many. We've tried to pick the ones that we think are doing something really special, that have got real long-term potential. It can be a bit frustrating for us at times, because we'd love to talk more about these companies, but because they're private, there are lots of things that we're just not able to talk about. But let me give you 2 examples and maybe tell you a little bit about why we're excited about them. So one would be Flix. So you might have seen their green buses driving around the UK. That's a bit of a misleading statement, because they're generally not Flix's buses. Its innovation was to recognize that fleet operators, so companies that operate buses, generally don't do a very good job at the front end. So ticketing solutions, yield management, pricing, route planning, that sort of thing. Whereas they tend to be much better at managing their fleets. So who's driving what bus, when, the maintenance, etc. So what Flix did was it separated the two. So Flix is doing the front end, it's doing that ticketing, yield management, etc. Whereas the bus companies are doing the fleet management side of things. And it thinks it can expand that far beyond Europe and the UK, where it's already made a tremendous success, into Latin America, into India, which are really, really substantial markets. And it takes quite a big take rate from the typical ticket that gets sold. So it shares the benefit of its productivity improvements with the fleet operators themselves. So we think that's got a very, very long runway for growth. It's also experimenting in trains on the continent. It'd be interesting to see how that evolves over time as well. The second example will be Bending Spoons, and it's nothing to do with Uri Geller. The company that operates out of Milan. It's sort of, how can I describe it? It's sort of like an acquirer of apps. So some of the famous apps that it has bought over the years would be WeTransfer, for example, which is used a lot by videographers, photographers who usually deal with very large file sizes, and it helps them just move those files very quickly and easily from one place to another. And another example would be Meetup, which is sort of like a Tinder for people who want to find people with similar interests. So it's a great way of finding local interest groups that you might like to join in your area, whether it's sort of local history, for example, or various other things. But what Bending Spoons does is it buys these apps. It recognizes massive efficiency savings. So a lot of these apps are sort of, West Coast. They're using very expensive labor. They're probably over-investing for growth. What Bending Spoons does is it makes them much more efficient, and it takes cost out, makes them right-sized, essentially. And that can release a lot of latent profitability these businesses haven't been generating in the past. And one of the things we like about Bending Spoons is that it reminds us of a lot of other companies that we've looked at that have been very successful as serial acquirers. So companies that grow through acquisition. And we've got a few of those in the portfolio. And we see some of the similar hallmarks here at Bending Spoons. So those are two really exciting unlisted holdings that we have in the portfolio. As I say, I'd love to be able to say more, but it's very difficult for us to go into specifics because they're private companies.
Well, I think we've had a real insight into, I think we've covered the brief of the unsung heroes. Do you want to go into a little bit more detail on the trust trades at a 15% discount? Why not liquidate your 3 least undervalued holdings and buy back stock? Have you considered that?
Well, the buying back of stock that's a decision for the board. So we generally, as managers, don't make decisions as to whether the trust should buy back shares. That's a decision that's taken by the board, and I think the board has been reasonably active in buying back shares over the course of the past 12 to 18 months. Generally, obviously, we have to raise capital to do that. So that's pretty much what the questioner describes is usually what we do. We will look at the holdings where perhaps we have the lowest levels of conviction in order to raise capital if and when the board decides that they want to buy back shares.
Okay. We've got one here on the interest rate cycle. So with interest rates potentially falling, does Baillie Gifford become a more attractive partner for growth companies?
Well, as I said earlier, we don't sort of spend a lot of time talking about what's going to happen with the interest rate cycle. I think it was John Galbraith who said that the job of economic forecasting is to make astrology look respectable. So we generally think that our strengths are analysing businesses and identifying businesses that have the power to continue growing over long periods of time in spite of economic conditions. Let's go back to Atlas Copco. So a Swedish compressor business. They have grown fantastically well for decades. And they've done that through the Swedish financial crisis in the 90s, through the dot-com crash, through the global financial crisis, through the pandemic, through numerous interest rate cycles up and down. What we're looking for ultimately is those businesses that have got something very, very special about them, whether it's pricing power, special culture, competitive advantage, that allows them to continue allocating capital at high rates of return over the long run. So we would put much more emphasis on that than the direction of interest rates. Now, interest rates clearly have an impact on equity markets and how stocks are valued, particularly the discount rate that gets plugged into people's discounted cash flow models and so on. But our focus really tends to be on those factors that allow companies to continue growing despite what is happening in the broader economic context.
Excellent. Okay. I've got a question on a specific stock here. Dassault Systems and Healthcare Businesses. It's been performing comparatively less well to Viva, its US competitor. So the audience member here is just trying to understand the dynamic there. What's different in the healthcare sort of systems and services businesses between Europe and the US?
Well, I think that's absolutely right. Viva has been doing extremely well. It is a very good competitor, and it's one that we've been learning a lot about over the course of the last 6 to 12 months. Dassault's strength historically was always in its core business. It basically digitized the automotive and aeronautical supply chains over a period of decades, and it's done an incredible job in those markets and is very embedded, a very important partner in those chains. And we our case for the life sciences business was that Dassault might be able to do something very similar in the drug development side of things. Now, I think it's fair to say that recent performance has not been quite what we hoped it would have been. As I mentioned, Viva is doing a very good job. They've been very ambitious. They've built a very impressive product portfolio. So the hope would be that Dassault really starts to build a portfolio that can really compete with that over the course of the next few years. But I think it's very much a subject that we're still learning about, and we may have more to say on that in the next few months.
Okay. This is a much more specific question about sort of Baillie Gifford setup. What are the core differences between European and American AI companies? Do you see European companies catching up anytime soon? Do you have any insight in kind of AI is the talk of the town, isn't it? Everybody wants a piece of that action. I suppose the question here is how is it playing out differently in Europe to the States, and what can one learn from the other?
Well, I think it's safe to say that there's been much more of a boom in the States than there has in Europe. What we would say is, our focus tends to be when you get these great transitions, and these happen periodically. We see something similar going on in the net zero transition at the moment as well. This is it's a massive change for society, for the economy, and it's going to have massive implications over the long term. But it's very, very difficult to pick some of the winners at the front end of that. So what we have tended to do is we've tended to focus a lot of our efforts on some of the more picks and shovels type businesses, the ones that are enabling that change. So in Europe, for example, if you think about one of the demands that AI will be placing everywhere in the world, really, it is that we will need more computing power, pretty simply. So how do you get that? Well, you need chips. You need more chips. You need chips that are more powerful over time. I mean, this is one of the reasons that NVIDIA is doing so exceptionally well in the US. But there are other parts to the semiconductor supply chain in Europe which we are invested in. So we've talked about ASML. Lithography is a really crucial component for ensuring that computational power continues to grow. We have an investment in a business called Soitec, a French semiconductor business which makes engineered substrates, which is quite interesting. So helping to get more productivity out of wafers. That's going to be important as well. So that's really where we focus a lot of our energy. It's on those picks and shovels. Anybody can look at AI and say, this is going to be big. But the really difficult thing is looking at which of those businesses are going to be able to successfully ride that wave and will still be here 5, 10, 15 years from now. I think that's a much, much harder question to answer.
And I think, but to your point about having exposure to the picks and shovels, we're still in that building of the infrastructure stage, and that, do you think the application of AI is kind of what everyone's getting excited about, but we're not, businesses are quite a long way away from fully utilising its potential, or fully realising its potential, sorry.
Yeah, I think what you will see is that it will have profound implications across companies, across the economy, but in profoundly different ways. Mm-hmm. Let's take the example of software development, for example, where we can see that there's very significant productivity uplifts when AI tools are used. But every company will have its own questions to answer about how AI is giving them opportunities, is threatening their business. And I think the answer will be very different depending on which company you talk to. But I think it's, so in some ways it'll affect every company that we currently own in some way, some more significant than others. And we're still thinking through how that works. But the broader point is that this is going to be significant. The way of investing in that does not require you betting on, it's a bit like the .com boom and bust. The internet was going to be a big thing, but which of the companies are going to be able to ride that wave and then survive afterwards? And the answer was not very many. So we have to be very careful when we're looking at the companies benefiting from this wave of innovation, that we find the ones that are able to endure over long periods of time. And you know, there are various characteristics there that we've already talked about that we'd be looking for. But you know, if you're trying to build a long-term sustainable business, you might be looking for businesses that have got some element of service to them, you know, where you've got regular interactions with customers, where you keep having to go back to fix things for them, where you have a contract where, you know, the customer needs you on a long-term view. So you know, we're looking very much at those picks and shovels businesses where we see those sorts of models quite often, and trying to figure out which of those are going to be there in 5, 10, 20 years' time. And certainly in the AI boom, ASML is, I think that's probably going to be one of the most important ones.
Excellent. Well, a great note to end on, because that's all we've got time for. So thank you very much for your time, Chris. And thank you guys for listening and for your insights and for your questions. We've got more sessions like this coming up, so do keep an eye out on those if you found today useful. Thank you very much.